Welcome to Subramani. I'm going to talk to you about a concept which I had written about in 2008. So when you look at these numbers, I'm going to give you a link to this article which I had done 12 years ago. When you look at the numbers, please adjust it for inflation. I have not done that. So what looks like 30 lakhs looks like a big figure, but that was in 2008. So just adjust it for inflation. It should look like more like 1 crore rather than like 30 lakhs. The concept that I'm going to talk about is why are big institutional investors a little more successful than small investors. There is one simple document called the investment philosophy statement. When you give money to a big institution, or when big institution puts together a corpus, they have to create a statement saying where they will invest, what they will do, what is the philosophy of the investment, and how they will rebalance. All that has to be written down. The broad statement. It is not that it will be followed to the T, but at least the direction will be known. Can we create an investment philosophy statement for ourselves? Well, some investors do, most investors do not. Investors who are organized and people who have been working in the operations and things like that, these are the people who prefer making an investment philosophy statement. Otherwise, people in sales, etc., don't bother too much, but I'm digressing. So what is this called? It's called an investment philosophy statement. We will call it IPS. What does it do? It spells out an investor's investment philosophy, asset allocation targets, and expected result. It also lays out a plan for how the investor will monitor his portfolio. So it could be called the investment philosophy or the investment strategy. The strategy is a smaller word compared to investment philosophy. All large organizations do that. Financial advisors can craft this for their investors, but many investors will not ask their financial advisors to do this. It just forces you to put your investment strategy in writing and commit to a disciplined investment plan. That is what the investment philosophy statement does. You can, at the link I've given you Sneha's investment philosophy statement. You could copy from it. You could please understand that all the numbers are 2008 based, so you may need to adjust it now. The inflation rate is different, the expected return on bonds is different, the expected return on equities is different, so you may have to adjust all that. So I'll just give you the executive summary. The important elements like current assets, time horizon, expected return, tolerable losses, how beyond which level you will not tolerate, which is kind of a stop loss on investments. Normally stop loss is a trading concept, but even in investments you can have a stop loss, and the portfolio benchmark, and they all appear at the beginning, and then you may not be able to estimate your risk taking ability to do the risk, so check out the risk portion in small bits, right? Then you can always come back to rebalance your portfolio. So here is the summary for Sneha. Sneha has total of 30 lakhs in assets, 3 million, and she has a time horizon of 16 years to retirement. She was then about 35 years of age. So this investment philosophy statement is for the next 46 years. So she was expecting to die at the age of 81. She's still alive and she's 47 years of age. Her portfolio is doing better than what she thought it would do, and so she has no great regrets. Overall portfolio expected return for Sneha is about 4% above the rate of inflation. This seems to be pretty high, but those days inflation was higher, so she's expecting that much. Today you should expect only about say 30% more than the inflation rate. So if inflation rate is 7%, you should expect about 9-10% in equities. That should be your expectation. This is what we call the real return. That is what she's expecting. Calculating this can be very tricky, so I suggest that you go with recent figures which have happened and keep on changing it on a year-to-year basis. Here is a guideline for what she wanted. She wanted all these percentages are above the inflation rate. So she wanted 6% in large cap, she wanted 6.5% in mid cap, she thought she'll get 5% in the index, and in bonds she was expecting 3%, right? In some bond funds she was expecting 3.25% more tax arbitrage than a real extra return. So if you have a balanced portfolio, then you again have to say how much you will rebalance. But Sneha decided not to have a rebalance she decided against a BAF kind of a fund. She thought she will do the rebalancing herself. Sneha's loss limit was about 15% in a single year, and over a 5-year period she was willing to lose about 3% per annum. So that is what she would lose. Anything above that and she would panic, and that she had decided that she would rebalance. Luckily for her, this was just after the 2008 2008 fall. So after that her portfolio has not fallen so much, not even during March 2020 did it fall that much. That was a time when she was a little worried, but she didn't act on it at all. She didn't do anything, neither did she buy, right? Here is her asset allocation. I'm not giving you these numbers because I'm giving you the link. You're better off reading from there. She had evaluation benchmarks. Neha she would compare the total return to the category and expect it to be in the top 30% of the category, and she was happy to reach her goals without having to do too much of rebalancing. She put money in Franklin India Blue Chip, which is doing badly. In 2005, the fund had returned 53%, but it tanked to the lower category end, and that didn't bother her. If that performance was, she was very clear that if the category, whatever be the category performance and the fund performance, if it was helping her in her goal, she wouldn't really bother too much. But one thing she did when the market went up and her portfolio went up, she started withdrawing from the equity fund and not just from her dividends. So to that extent, yes, some little bit of profit taking has happened. And after that, her goals were very clear, and they were also stated then, to retire in 16 years, out of which about 12 years have passed. She is online for a 4-year, in 4 years she will be able to retire. To be able to spend about 300,000 a year, that's about 25,000 a month post-tax during retirement, adjusted for inflation, it would mean about 55,000 rupees. To make her assets last her lifetime. She is single, she has no other people to provide for, and she is happy decimating her assets to zero by the time she goes. She has no reason to leave anything back for anybody. She will balance taking on as much risk as possible to achieve a higher return. She wanted a higher return, and she was sure she will not panic in a downturn. She did not panic in a downturn. I can say that with 12 years of watching her. Recognizing that she will never know which asset class will outperform, she wanted to diversify across a wide range of opportunities, including investing abroad. But she was not very sure how she had to invest abroad. She will control costs by limiting expenses, fees, etc. At her age of 70, she hopes to be able to shift all her money to RBI bonds and sleep peacefully. Every person has their own constraints and unique circumstances, so that has to be captured. Sneha has more than 10 years. She can afford to tolerate short-term fluctuations, which she did very well. She believes in the concept that she will do the asset allocation herself, and therefore no balance funds for her. She was keen to put some money in international funds because I had no clue how to pick international funds for her, and she wanted to do it herself. We were not very clear, so there were some shares which she had bought, including Tata Motors, in which she's got hurt. She has enough capital gains in her equity portfolio, and that time we had decided that we will sell partly, and because of the grandfathering impact, she doesn't have too much of taxable capital gains left, and that's it. So these are the things which you should have in your philosophy statement. I've given you the link, and you should be able to create your own philosophy statement. This is Neha's. You can do your own copying. She's very worried about style purity, so she does not like a fund which says it's a large cap but invests in mid cap. So HDFC Equity was a very funny fund for her. She had some money in that and she got out saying they have no clue what they are doing. So, well, that's her view. And we said, okay, we will do the review once in 2 years. That's happening. Thank you.